On today's Editor's Cut, we're dealing with a couple of stories. The first relates to the latest update from the regulator, the SEBI, that talks about short selling. Is there really anything that you need to know about that is new in the latest update, or is this essentially business as usual? Sajith will tell you about some of that, and then we'll focus in on the jewelry companies led by Titan. Of course, you've got the latest business updates, and that indicates that growth is stronger than ever. So we'll talk about some of the nitty-gritties there. But let's start with the first conversation, which is short sellers. I've heard it being described on social media, Sajith, as a nothing burger. Is that true?
That's true, because it's basically a circular that came in 2007 when the entire short selling was put in place for all kind of investors. But it was accompanied by something called the stock lending and borrowing mechanism. So any investor, whether retail or HNI or institutions, can do a short sell provided they have borrowed the stock and then they have done it. So it has to be accompanied by an SLBM mechanism, which hasn't picked up much, but of late there has been some kind of transition where we have seen over 100, 125 stocks where we have seen lending happening for those stocks. It also requires a good institutional mechanism before a short sell can be done, because you need to borrow from the institution and then deliver the stock so that the custodians can do the delivery, and as and when, and there is a charge which is being given. So many of the institutions which are holding stocks for long term period, they can get additional returns based on the lending that they do of the stocks which is there. But interestingly, I wanted to bring in the SLBM here. While the notification on Friday was just a reiteration, and maybe they must have missed out 1 or 2 points and they've been putting it back to the master circular, the SLBM or the stock lending and borrowing mechanism is now evolving into a good mechanism here, because if I look at some of the stocks which are be there, you have nearly 4 million shares which are outstanding for IDFC first. You have AU Bank where 3 million shares are active, outstanding. Jubilant Food, Colgate Palmolive, Tata Com, Mahindra Finance, Muthoot Fin, Mahindra and Mahindra, Tata Chem and Tata Consumer. So these are some of the, mostly it's financial stocks where you don't get to do much because especially some of them are a small bank or where the FI holding is much higher. So they have taken a counter position by shorting the stock and then borrowing and lending it for the settlement. But it is emerging into a big thing, something which I think the market will now look at it, because in the context of how it has moved over the last 1 year, 1 year back it wasn't so big. Yeah. Now it's...
So, but naked shorts were not allowed, naked shorts are still not allowed.
Never allowed.
But now what I was reading is that there is something related to the disclosure if you are borrowing too short. Is that new?
It's also old one, 2007 one, where if you're going to do a short, you need to inform in advance that it's a short position so that the custodians are aware that you're going to, borrow from one of the lenders or one of the institutions and then supply the stocks, because the settlement doesn't change just because you've done a short. You have to supply the stock here. Either you do it from your portfolio or you borrow it from someone else who's willing to lend you for a fee.
Agam, your reading, nothing changes?
No, not really. But, Alex, among the names that Sajith spoke about, first thing interesting is that we are at life highs right now. And I'm going to start wondering now if we are actually going to see an increase in the number of stocks which are in SLBM. Of course, Sajith just mentioned a handful of stocks, but from what we understand is about 150 stocks where it has been in SLBM. Secondly, in the futures and options space, we need to see if there are significant amount of shorts which have also built up in these stocks. That could in fact give you a reasonable amount of expectation, at least from the people who are holding these positions. Shorts in cash and shorts in the futures and options space. Thirdly, also want to take a look at whether or not any of these stocks are in the F&O ban. If they are in the F&O ban, you're not going to be able to carry on positions, which means that you may want to in fact take positions in cash as well to go short.
Last interpretation, and then we'll move quickly to the jewelry conversation. But if the market is aware of, if people are aware that there are certain number of short positions and essentially who has taken them, would there be a possibility of squeezes taking place? Because you have the knowledge that there are a certain number of shorts.
100%, Alex. It is a very dangerous position. And yes, a squeeze is always possible, especially when you already have significant amount of shorts in SLBM as well as futures. And we tend to think that it's the cash markets that drive things, but it's not always the case. If you do see attraction in the futures space as well, you could in fact precipitate the covering in your cash markets as well. So it's it's kind of coupled.
So if your stock is on a ban in FNO and they're not able to take fresh positions, you can easily go into cash market, do a short and cover, use it using a lending mechanism, or borrow the stock and do the shorts there. So it is now getting coupled in such a way that there may be some kind of a new market which has been developed in because now you have lots of institutions now lending stocks there, but you need to see what is the kind of carry fees which has been allowed and how it's moving.
Fair point. I understand for a few of our viewers that this is going to be a little bit of a technical conversation. So if you've got specific questions on this, let us know in the comment section or indeed on the WhatsApp number. And in fact, we will do a special session with both Agam and possibly Neeraj and Sajith as well to tell you what this is all about. For now, let's shift to the jewelry conversation. Strong numbers, Agam. Yeah. I think the question is whether or not, and a lot of brokerages also coming out to say, hey, these companies are good to buy even at these levels.
Right.
Are the valuations stretched at all is a question.
But, Alex, we're talking about Titan in this case specifically.
Yeah.
The valuations have always been stretched.
Correct.
And, but the truth is that Titan keeps coming up to back those valuations, right? We continue to think that where does Titan get its growth from if the market is actually saturated? But we have to also understand that there is a very, very large unorganized market out there, and that's where Titan is taking advantage of, which means that there is space for not only Titan to grow, but a lot of its peers as well. Hence, a lot of its peers in the jewelry segment are also doing well. Now, after Titan, now people tend to start thinking about Kalyan Jewelers as well, because the business model is slightly similar. Titan specifically, we've seen about a 23% growth indicated in this quarterly update coming through. And besides that, about 3 years ago, 70% of its revenues came from the jewelry segment. At the moment, I'm looking at the first half revenues, it's nearly 90%. Nearly 90%, and it's doing well, at least in terms of growth. Even at the size at which Titan is currently, if at that point in time it still comes out with a 20% growth on a year-on-year basis, and mind you, in the last quarter, that is third quarter FY23, it saw about 11% growth. This time around, it's seeing a 23% growth. So this is on a reasonably high base. Of course, we must remember that there was a little bit of a delay when it comes to festive sales in this particular quarter, and that also combined with the jewelry segment, the wedding season, which also came together, which is why potentially Titan has maybe seen a slightly better than expected quarter coming through. Very quickly, to compare Titan with respect to the other listed players, and you see that despite its size, Titan still has superiority in a lot of brackets out there. So even in the past 3 years, it has seen the most amount of growth in terms of its earnings. 37% CAGR as against something like a Kalyan, Thangamayil or a Senco, all of them having similar business models and not as good as Titan. Even in terms of margins, the jewelry margins are much higher as compared to its peers, as you can see on your screen there. In fact, double-digit margins for Titan as compared to Senco, Kalyan and Thangamayil. Coming down to valuations, of course, Titan is expensive. And I reckon that to a certain extent, a lot of analysts believe that it's going to remain expensive because of the kind of superiority it has in several other metrics. And even in terms of the premium segment, it rules the roost. And there will be a little bit of catch-up with respect to the other jewelry players. But for now, of course, Titan is a clear winner.
Oh, absolutely. All right. So I think that's more or less a comprehensive view on the jewelry space. And if anything, it's a stamp of acceptance on Titan's performance. Certainly, its valuations are being backed by a performance. Let us know what you think and if you hold Titan as well.